Atlas Engineered Products, AEP, on the TSX Venture, currently trading at a price of about $1.32 and about an $85 million market cap. So they design, manufacture, and sell engineered roof trusses, floor trusses, and wall panels, and distribute engineered wood products for use by builders of residential and commercial wood-framed buildings. And the company's strategy is focused on profitability and organic revenue growth within its current markets and the pursuit of a roll-up acquisition strategy to consolidate similar companies operating in the truss and engineered wood products industry across Canada. So I covered Atlas back in February of 2023 and again more recently in July of 2024. And the last time that I covered it, I indicated that the business was not cheap based on its trailing numbers, trading at 40 times trailing earnings and 15 times enterprise value to EBITDA. Given the market is anticipating the company's recent investments to propel the financials over the next 2 years. So, quickly updating the business here. The company has made 8 acquisitions since going public in 2017, with the most recent acquisition in August of 2023 when it acquired Leon Chouinard, which is located in New Brunswick, which I did touch on briefly in July when I covered the stock last. And just last week, the company announced that it completed due diligence for a truss manufacturing company located in Western Canada and intends to close the transaction in early spring of 2025. And the purchase price is about $3.8 million in cash and stock, plus a working capital adjustment. And the acquisition target generated about 3-year average revenues of over $11 million, net income of about just under $1 million, and adjusted EBITDA was about $1.2 million. The CEO also mentioned on the conference call that they are seeing potential deal flow very, very strong at the moment. So, that is definitely something that we're going to be talking to Hattie about when we sit down with him in the next couple of days here. So I also kind of touched on these in July as well, but I'll briefly mention them. On June 26th of this year, Atlas closed a bought deal and concurrent brokered private placement for aggregate proceeds of $14.5 million through the issuance of about 10.8 million shares at a price of $1.35 per share. So the share count should now be closer to, I believe, about 69 million shares outstanding. And on June 6th, the company announced that it accepted proposals for the installation of robotic automation equipment at 3 of its locations, and that it has made initial deposits to secure the installation of equipment. And the robotics installation is expected to have a total cost of just over $7 million for all 3 of its locations. And the robotic automation is anticipated to double the board foot output of roof truss manufacturing while providing potentially significant cost savings. And I saw an estimate from a CoreMark report, which placed the estimated robotics initiative to cost between 25 to 26 million Canadian over the next 2 years, with a new greenfield facility accounting for about 15 to 17 million. And the investments are expected to increase truss manufacturing capacity by about 400% at High Tech, 100% at LCF, which is the acquisition that I just briefly mentioned there before, which they made in August of 2023, and about 50% from Clinton, which is all in all expected to lower operating expenses and approximately a 50% reduction in labor costs. Again, we're going to be asking CEO about this just to get some more color here. And the robotics upgrades are expected to be completed over the next 2 years. Now, moving on to the recent financials for Q2 of 2024, it was a pretty decent quarter due to the acquisitions, but revenue increased about 34% to $15.1 million, again, due to acquisition growth as well as some organic sales growth. Adjusted EBITDA was up 50% to $3.1 million due to an increase in revenue. And net income was down about 10% to $700,000 or about 1 cent per share, due primarily to the amortization related to the intangible assets of the LCF acquisition. The balance sheet looks quite healthy. They have about $20 million in cash with $29.9 million in debt and leases, providing a net debt position of just under $10 million. And the company has a trailing net debt to EBITDA multiple of about 1 times, which is reasonable. And just looking at the outlook, management indicates that markets continue to be very competitive in 2024, given rising interest rates, which have affected the housing market and the company's near term growth. But the company notes that it recognizes the need to be ready for a potential significant increase in demand as interest rates decrease during 2024, given the number of homes still needed to be built to support Canada's population growth. But again, management did say, there's a lagging effect as interest rates come down and when this demand will come. So I thought it would be representative this time to show some rough pro forma numbers for fiscal year 2025. Keep in mind, these are very rough. But essentially, this is what is allowing the stock to hold up quite well despite headwinds across the sector, given elevated interest rates. So if we include fiscal year 2023 financials as a base, and add about 7 months from the LCF acquisition, which was closed August of 2023, as well as 8 months of the new acquisition, which we are hypothesizing will close in May of 2025. Again, we have no idea if it'll actually close in May of 2025. Could be later, could be earlier. Along with potential 50% labor savings from the robotics investments, we would be looking at revenue of approximately 71.7 million for 2025, adjusted EBITDA of about 20.9 million, and net income of about 12.8 million. Now, keep in mind, again, I am making assumptions here, which may or may not come to fruition, including potential cost savings being realized in 2025, which may actually only come in fiscal year 2026. It does not include any unexpected acquisition costs or drag on earnings from investments, as well as assuming the acquisition will close in the spring of 2025, specifically in May, like I said. So again, please take these figures with a grain of salt. But if we use these figures to look forward, the company is trading at about 6.6 times forward earnings and with an enterprise value to EBITDA multiple of about 4.5 times forward. So as you can see with my pro forma numbers, the stock is holding up quite well, given the assumption that forward numbers will look quite well. Despite the headwinds that we're seeing across the sector, plus the shortage of Canadian homes appears to provide a good runway for growth for Atlas, or at least that's what management has been indicating. And whether I think, it's a buy, sell, or hold, I think it really comes down to whether an investor believes Atlas will be able to fulfill their new upcoming capacity, moving into 2026 and capitalize on the potential cost savings, which could grow earnings over the next few years. But again, we are seeing, elevated interest rates potentially disrupting the company's near-term growth. In fact, as I was mentioning that CoreMark report, they've actually reduced their outlook quite substantially. And even my revenue numbers are more modest than even what they're anticipating for fiscal year 2025. So as Ryan said, we will be speaking with management on Thursday this week to get some more insight on the potential cost savings, strategy, and ability to fulfill capacity, and for us to get more color on the current market environment given elevated interest rates. So if you have any questions that you would like me to ask management, feel free to comment them on YouTube as soon as possible to make sure that I see them before our actual interview, and I will try to make sure that we ask them.
Yeah, it's a good summary. I mean, certainly a company we are interested to talk to. I mean,
Yeah,
if they can hit on those numbers, 18 months out from where we are now, then, 16 months, if it looks, it would look attractive at that point, but there's a lot of ifs
exactly.
for them
I
getting
think that
there
there's
over
the
that time.
like what the company's betting on here, which maybe isn't an unreasonable bet, but they're betting on a big increase in demand, right? So
Yeah.
I see huge production capacity increases at their facilities. But what do they like? What do they need to do to get that 50% labor cost savings, right? I mean, I imagine they need to be operating somewhat near capacity or above a certain level.
Part of
So
it is
the
like
question is,
automation too, right? A
Yeah.
big
sorry.
part of it. Automation is a big part of it, like robotics they've installed. Automation.
Certainly, but if you build robotics to that are capable of producing like say 1,000 units a year, and you only have orders for 200 units per year, then you're depending on how you're going
Yeah,
to
I think you
expense
got to
those
have
other
both
costs.
things
It's
combined, demand and using
Yeah.
the
mhm.
new equipment for
So, and
sure.
I mean,
Yeah.
and I mean, I think that it's reasonable to think that there's a good probability that, demand is going to increase, because they're right. We do have a housing shortage here. Rates are starting to come down, but they're making a major investment. And if it doesn't play out in the time frame that they're planning on, that's a risk. But I mean, in all things, there's a risk. It's interesting business. I like the idea of investing in efficiency.
Yeah,
Yeah,
you bet.
if you see a recession and a housing slump for a year and a half, they're not going to hit those numbers. So I mean that's I mean, in all likelihood. But if see a normalization and an increase in the housing market, like they could hit or beat those numbers. So I mean that you're you're overlaying a prediction on the economic out or on the economy generally speaking into this company as risk. But most companies have some economic risk. This would be on the higher end of that. Building is can be boom or bust relative to some other segments.